Yeah, so in weather terminology, it's foggy.
We've got the chill, yeah.
It's slightly foggy, but it was like a mild pullback and it's a mild gap down start. So the word here is actually mild, the kind of mild winter we're experiencing in Mumbai. So that is the setup of the market. Frankly, I will not read too much into yesterday's price action, but for me, I think January would be a month where you're unlikely to see big and sharp gains. Gains will be followed by a routine bout of profit booking. You do not want to chase the market on good days. You want to wait for market to come down on bad days. Indian markets were helped by two factors last week: big comeback in Reliance and a bout of short covering in IT. Those two factors I think have panned out beautifully. Now in the near term, the market would have to look for a new trigger, and which I frankly don't see that there are too many triggers on the horizon. So for me, the definition of the market is that the path of least resistance is markets they want to go higher. B, you want to participate by buying on a bad day closer to support levels rather than chasing the market after 2 or 3 good days of uptick. So mild profit booking, mild selling by institutional investors, and mild weakness in large cap stocks. Everything is just mild this morning.
Yeah. Yeah, we're about 230 odd points gone on the Dow overnight, about 17 odd points of pause coming in for the S&P 500 index, and mildly soft for the Nasdaq as well. But Asia too is, by the way, mirroring the same sentiment. You've just got the China fourth quarter GDP numbers, which have clearly missed the mark, and also they've resumed posting youth unemployment data after a long hiatus. And across the screen, you are seeing sharp cuts evolving. In fact, Shanghai is now down almost 1%, Hong Kong down 2.5%, no less. We are headed in for almost a 400-point decline for the HSI. Kospi as well lower by about 1.6%, and the periphery markets as well are looking gloomy. And sure enough, the GIFT Nifty as well indicating a weak start for us. The implied open itself seems like you're going to knock off about 200 points on open. But today I think it's going to be HDFC Bank, which is going to be the talking point, and I think that's also going to be a big drag.
Absolutely, it is certainly going to be. So let's just discuss that in greater detail in terms of the kind of earnings roundup as well that we witnessed. The standalone provisions, they came in elevated on a sequential basis. This is for HDFC Bank with the NII that was up about 4%, and you had the overall profits which grew about 2.5% on a QOQ basis. Downgrades, certain brokerages seem to be downgrading and HDFC Bank. And Nikunj, like you said, the street would be looking at this one with a magnifying glass. The fact that anyway the expectation is it could be a gap down open. What's the view?
See, I'll address both the aspects. First,
yeah,
the numbers. If you just look at numbers independently, there's nothing wow about the numbers. There is nothing exciting about the numbers. If at all, cracks are now opening up in terms of what the HDFC Bank positioning and what the delivery has been. I think for the first time after many quarters, you've actually seen the first year-on-year EPS decline in a decade. And there is definitely a pressure which is building up because of what is happening in the entire liability side, which is the cost of deposit, and growth seems to be getting challenged for HDFC Bank. Now, it is a stock which is unlikely to see any re-rating in the near term. It's a stock where positioning is just one-sided, which is everybody is just hoping and hoping and hoping that HDFC Bank will actually catch up because of months of underperformance. Now that's the positioning. So the stock post these numbers is unlikely to move higher like what IT stocks did. The general mood point at the beginning of the week was that buy stocks ahead of the numbers. The kind of move what we've seen in IT, we are likely to see that in bank. But looking at HDFC Bank numbers, I don't think we are in for a bout of short covering. If at all, I think HDFC Bank, which has been a ranked underperformer, that positioning of HDFC Bank is unlikely to change. So if you're holding on to HDFC Bank, I guess you should not sell. if you get a bad day, if the stock falls for 5%, you should add more. But to assume that there is going to be instant gratification and you will make very smart gains by buying HDFC Bank in next 2 or 3 months, I think that really may not be the scenario. Somehow, yesterday everyone started discussing, and I don't know why, that okay, go and buy banks because what you saw in IT, you could see a similar kind of a short covering rally in banks. That's not going to happen. And if at all HDFC Bank now post these numbers, it's unlikely to be that outlier or the outperformer. So I think the wait and watch mode continues for HDFC Bank. Frankly, these numbers do not warrant that kind of an excitement. I mean, they are just not impressive at all. A franchise like HDFC Bank, when the economy is so strong, everybody has come out and cut their EPS growth targets and also the growth targets.
Yeah, absolutely. If we were to just, pull out the list of how brokerages have reacted. So Nomura has cut the target price from the earlier 1750 to now 1625. So they maintain a neutral stance. Axis Capital, they've also cut their FY 25-26 estimates by 4 to 5%. They're saying estimates are going to factor in a slower loan growth and lower NIMs as well. CLSA though, they've got a buy. They've cut their estimate though about 3 to 5% on account of the lower deposit and loan growth. Morgan Stanley maintains its overweight. Nuvama has got a neutral with a target price of 1730. So yes, the tilt is definitely towards the downside on HDFC Bank, although some brokerages are having their neutral and overweight and buy stance as well on HDFC Bank. Let's see where the stock heads from here, because overnight, of course, you had the ADR slashed down by about 3%, and at one point in time, it was down about almost 5% as well. But back to markets, given how, it seems that, Nikunj, that IT wave clearly is over. Once again, overnight, you had a big reversal in how the Wipro GDR, for instance, or ADR, I beg your pardon, actually performed overnight. So seems like that IT move is now done with. Now it's going to be the turn of banks, HDFC Bank. Next, you'll have ICICI Bank. And then, of course, on Friday, you've got Reliance. So, you've really got to sort of hold back, do nothing, I guess, in this market.
See, Aisha, this is not a market where you will see pronounced momentum. This is not a market where you should actually be buying on good days. I think the strategy in this kind of a market is very simple. We are in an uptrend, but the pace of the rally will slow down significantly. You will not see big moves, but you will see shallow moves, perhaps on shallow moves when it comes to benchmark indices. Now, the path of least resistance is higher. But if you're buying after 4 or 5 days of straight line gain, then perhaps in the near term, the margin of safety is not there. So if you're a pure trader, I mean, if you're a hand-on-heart trader with a near-term outlook, say that, look, for me, the world revolves the next 15 days or next 1 month when it comes to benchmark indices. In that case, you should buy on bad days, close to the support level, let a little bit of panic set in, you want to be a buyer that day. Similarly, when you get 4 or 5 days of good gains like what we saw earlier this week and last week, you actually want to be a seller. The strategy is very simple. Don't chase the market. Let the prices come to you. October, November, December, the strategy was buy high, sell higher, and then buy even higher and sell even higher, because markets give you a linear move. That's not going to happen. Don't go short. Don't chase the market. Go to that ordinary plain vanilla strategy. Buy on a bad day, sell in a good patch. It's very simple, but it is a big departure from what you've done, let's say, in the last quarter. What could be the next trigger? I'm not so sure, because Reliance has fired, HDFC Bank has disappointed, and IT has done their bit in terms of the positioning change.